Hi everyone, it's Nancy Godrad. In this video, we're going to talk about the remaining part of Chapter 2. Going over a couple of examples for journalizing and posting and eventually preparing an internal report called Trial Balance, and we're going to go over the purpose of it. So this 9 steps are the steps in accounting cycle, and the steps 1, 2, 3, and 4 is discussed in Chapter 2. So I also want to go over another document which is called a chart of accounts. Chart of accounts is a list of all the accounts that the company has and an account number that is assigned to each account. Who decides on the account number? The accountant can decide on the account number. So here for Pioneer Advertising, we have decided that we're going to use the range 101 to 199 for our assets and 200 to 299 for our liabilities and so forth. Now, if you're using a computerized accounting software, the account numbers already been created by the publisher of that computerized accounting software. Now, let's go over a couple of examples for journalizing. In this example, it looks like that the owner invested $10,000 cash in the company called Pioneer Advertising. So if you want to go over basic analysis that we did in Chapter 1, assets increase, stockholders' equity increase. Now, in Chapter 2, we have to be very specific which asset, which part of stockholders' equity, cash and common stock. And then we need to use our convention as far as increasing assets. We need to debit assets. As far as increasing common stock, we credit common stock. As I mentioned in the previous lecture tape, is that the name of the account that is debited always written first in that entry, and the name of the account that is credited should be indented. And eventually, after journal entry, we need to post, meaning transfer the data to the respective accounts in the general ledger. So in this case, the 10,000 debit to cash goes on the debit side of T account for cash, and the 10,000 credit to common stock goes to the credit side of common stock T account. And the account number is written on the reference column of general journal. Now, remember, each transaction must have at least one debit and one credit, and the total dollar amount for debits must equal the total dollar amounts for credits. Can a transaction have more than 2 accounts affected? Yes. A transaction that has only 2 accounts affected is called simple entry. A transaction that has more than 2 accounts affected is called a compound entry. So let's go over a compound entry for you. I had one somewhere here. I'll come to it later. So in this transaction, the company has purchased equipment, and they didn't have cash, so they signed notes payable. They signed a piece of paper, a note, promising to pay the amount they borrowed, which is called the principal, 5,000, plus interest on that amount. Now, the interest is always for 1 year, but since they borrowed it for 3 months, they only have to pay 4% on the 5,000. And in accounting 10, in financial accounting, until we get to Chapter 10, we always assume that the loan and its interest is paid at the same time when the amount is due to the bank or to the person we borrowed money from. So analysis shows that an asset called equipment increased and a liability called notes payable increased for $5,000. To increase assets, we need to debit assets. To increase liabilities, we need to credit liability. Therefore, the name of the account that is debited, equipment, is written first. Then the name of the account that is credited is indented below that, and the amounts are $5,000. The next step is transferring this journal entry to affected accounts in the general ledger. Equipment T account is going to be debited for $5,000, and the account number 157 is written in the reference column of general journal. The credit side of the entry goes to notes payable T account, and the account number 200 is written on the reference column of general journal. Now, we're going to go over what is unearned service revenue, or unearned revenue for short. That's when the company receives cash from client for services to be provided in future. Which type of companies have that? Attorneys normally have that. They might get a retainer for a case, so they're getting cash upfront from client for services to be provided in a case in future. In this case, cash increases, which is an asset, and a liability is also increased because we owe the client the service, or we have to give their money back if we don't do the service. The name of this liability is different. It's called unearned revenue. Unearned because we haven't done the job yet, so we haven't earned it. Even though the title has revenue in it, it is not a revenue. It's unearned. It means we still owe money to the client or the service. That's why we debit cash and credit the liability to increase it, unearned service revenue. And again, we're gonna now post this transaction to the respective T accounts in general ledger. Once you have a T account for cash, you're gonna use the same T account for the entire life of the company. Or if you use a standard format account, which companies do in their formal records, they don't use T account. We're using it just for teaching purposes. So the other transaction I wanted to go over was this one. When the company pays 1 year insurance policy, we will create a new asset called prepaid insurance. Why is this an asset? Because it provides benefit today and in future. Therefore, an asset called prepaid insurance increases, and since we paid cash, which is a different asset, decreases. So this transaction is only affecting the left side of the basic accounting equation and not the right side at all. No effect on the right side. To increase an asset, you debit it, so prepaid insurance is debited. To decrease an asset, you credit it. So you have to always make sure you have at least one debit, one credit, and the total dollar amount that is being debited equals the total dollar amount that is being credited. Again, write the name of the account that is debited in the entry first, and below that, with the indentation, write down the name of the account that is being credited. So in this case, the 600 is going to go to the T account cash in the credit side, and we're going to create a new account called prepaid insurance and put $600 on the debit side of it. Okay, now guys, after all transactions have been posted, we need to prepare a report called trial balance. Before I do that, I wanted to show you a transaction that does not need recording because you cannot measure it in dollars and cents yet. So in this case, the company hired employees and they told them how much they're going to receive. However, we won't have a transaction that needs recording until the employee actually works for us, and at that time we do owe employee money for the amount of their work. And when we pay them, or when it's time to prepare our financial statements, whichever comes first, we need to record the entry for their wages or salaries. Now, let's see what else I wanted to go. So this is the general journal listed for all the transaction for Pioneer Advertising in October, and eventually posting them to, in this case, a standard format account, so we can make a distinction between the T account we were using before and the standard format account. So after we do the transfer to our general ledger, all journal entries have been transferred. The next step is to prepare an internal report called trial balance. In the trial balance, you have to write the name of the company, the name of the report, and the date, which is always the end of a month. And trial balance will have 3 columns: the name of the accounts, a debit column, a credit column. Where do we get the data for the debit and credit column and the name of the accounts? We get the data from general ledger. If you look at it, cash has an ending balance of $15,200, supplies $2,500, prepaid insurance $600, $5,000 for equipment, $5,000 for notes payable, but you gotta know which column to put these on. Assets should go on the debit column, liabilities and common stock on the credit column, dividends on the debit column, revenue credit column, and expenses on debit column. So the order of the accounts is the order of the general ledger. And we're only bringing the ending balances, not the activity, just the ending balance. And then the last thing we do, we're going to add up all the numbers on the debit column and write down the total. Add up all the numbers on the credit column, add up the total, write down the total. The total of debit column must always equal the total on the credit column. If it doesn't, it means we made a mistake in our posting or in our journalizing. The whole purpose of preparing a trial balance is to make sure the total debits that we have made equals our total credits. And if it doesn't, then it means we need to go find where we made the mistake. Of course, trial balance has limitations, meaning that even if it is in balance means total debit column equals total credit column, there might be still some errors that we cannot catch. We might catch them later on in the accounting cycle. And the errors that we cannot catch is listed here. Such as if we use incorrect accounts. Let's say instead of supplies, when we purchased it, I debited equipment. I mean, an account was debited for $2,000. It was the wrong account, but it will still, our trial balance will balance. So this is one of the errors that you cannot catch by preparing a trial balance. Now, dollar signs do not appear in journals and ledgers. However, they do appear in all our reports, such as trial balance and financial statement. And we single line under the column of figures to be added or subtracted, and double underline under totals. Okay, guys, if you have any questions, please email me. And I hope you're doing well in chapter 2, and we're gonna create more videos for chapter 3. Talk to you soon.